Good afternoon, ladies and gentlemen, and welcome to the CT UK High Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish all those responses on the Investor Meet Company platform where it's appropriate to do so. Before we begin, I would like to submit the following poll, which will just appear on your screens now. And I would now like to hand you over to Managing Director David Moss. Good afternoon, sir.
Good afternoon, Jake. Thank you very much. And thank you everyone for taking the time to listen to me this afternoon. So I'm David Moss. I am the fund manager of the CT UK High Income Trust. And what I'm going to talk about today is the agenda that you see in front of you now. So firstly, briefly talk about Columbia Threadneedle Investments. Who are we? I think it's important to talk about the backdrop, the UK. The trust currently owns 36 stocks out of the many hundreds one could buy in the UK market. And we're very much bottom-up investors. We focus on the qualities of an individual company. But nevertheless, we think it's important to understand the UK backdrop, particularly with so much negative press around. I'll then lead into talk a bit about the valuation and why we think it's a very attractive place to invest. And then why you should invest in the UK through CT UK High Income. And I'll finish with some stock examples, which we believe will help to demonstrate the attractiveness of the type of businesses that are on offer in the UK. I'll just leave slide 3 there for a moment, so you can look at the important information that says investments can go up and go down. So I'll leave that for your reading. And then we'll move on to briefly Columbia Threadneedle Investments. We are a globally connected asset management firm. We operate in over 1,700 countries. We have over 200 plus research analysts, and that goes to the point about we are intense about research. What that means is we look first and foremost at research in our companies as well as we can. We want to make sure we understand as much as we possibly can about any business, what it does, how it makes money, what are the threats to its business, before we put any of our clients' money into these companies. And that's a key part for us. That's why there are so many analysts. We have in total over 481 billion pounds of assets under management globally. So we are a business with tremendous scale across the globe. And in total, we have over 650 investment professionals. So a large, well-connected business that has the resources to deliver results for our clients. So as I said, I wanted to start some brief comments on the UK, and I'll go into a little bit more detail because I think it's important to address some of the fears out there, some of the things which I think are wrong about why the UK is, in our view, an attractive place to invest. And again, we are bottom-up investors. We not invest top-down, but we need to think about these things in the first place. So it is true, of course, that the UK economy has been weakening and inflation has remained high. And that in many ways is the crux of the negative view around the UK. But actually, we believe, and I will demonstrate this with some of the slides in a moment, no worse in aggregate than other areas. We believe on top of this, there are signs of stabilisation. Employment, while worsening, remains robust and wage growth continues, which is helping at least to offset some of the impacts of inflation that's coming through in cost of living. On top of that, lead indicators of inflation are actually improving. And there's a high chance now that UK mortgage rates have peaked. Obviously, in the UK economy, with such importance placed on housing, this is very important. And again, we'll talk a bit more about that as we go through. And then I'll show a couple of slides to talk about how attractively valued the UK is on any measure that we can think about. So first of all, let's think about economic activity. Yes, it's weakening. And we show here the Composite Purchasing Managers Indices, which is a very long-running, well-watched form of survey data that says, yes, the UK is slowing. But if we look to the right-hand side, we can see this is not particularly out of tune with other major economies. So little to differentiate the UK in a negative sense here. Moving on, the second of the 2 points at the front was inflation. And yes, inflation post-COVID, supply chain issues that many of us know about, did go up aggressively and stayed stubbornly high for some time, as it did really elsewhere. And yes, inflation, core inflation in the UK remains an outlier to the other two major developed economic blocks, but it is falling and it's not massively out of sync with other areas. So again, UK is a little bit worse, but not substantially. The result, of course, or as a result of that increase in inflation, we saw central banks react to raise rates very aggressively to deal with this problem. Of course, not something we've seen for a very long period of time, and the pace of rate increase has been very aggressive. But again, I'd point to the very right-hand side of this slide, which shows you that this is not, again, out of sync with other major economies. So the pace of change was pretty much the same. We've gone to a peak that's probably higher than the Eurozone and slightly less than the US. So we look at these three things, and the UK has been weakening, but no worse. Inflation has been higher, but really not very much worse. And the response in terms of interest rates, again, has been pretty much in line with the rest of the world, the developed world, I should say. This leads me to one particular point, which is about the UK consumer. I'm sure we've all read widely about the impacts of interest rates on the consumer, particularly homeowners that have mortgages, and how bad that can be when it was possible to get mortgage rates probably under 1% a couple of years ago, and now they're 4, 5 or 6 depending on one's individual mortgage. However, while we would not in any way seek to ignore many consumers who have been hurt by the cost of living crisis and who have seen their mortgage rate rise very aggressively, in aggregate terms, it's not clear that the impact of rising UK rates has not actually been positive for the UK. So why is this? How can this be the case? The first point is that the majority of homes in the UK are actually owned outright. So there is no mortgage, so rising interest rates are not a positive. Secondly, for a large part of consumers, because of the prevalence of fixed rates in the United Kingdom, mainly 3 or 5 years, actually the rise in interest rates hasn't yet been felt by a large proportion of consumers. So even those consumers who have a mortgage haven't seen their mortgage payments rise because they're still on very attractive fixed rates. Now, clearly this will change over time, but it does change gradually. And lastly, again, we would have read at length about how bad the banks have been about passing on interest rates in terms of deposit holders. But actually the rise in rates has been positive in terms of the ability of people who actually have deposits to earn income. And while clearly there's been no move on current accounts, there are several fixed term deposits now that can earn 5 or even 6%. So savers have been benefited. So in aggregate, we won't deny, as I said earlier, that a portion of the economy is negative for, but the overall impact has been nowhere near as bad, we believe, as the sort of media would like us to believe. So that's, I think, certainly worth thinking about, because sentiment around housing is absolutely crucial for consumption in the UK. And as we know, consumption is the biggest driver of economic growth in most developed economies. And then we have the fact that actually it looks like mortgage rates are coming down. You may be surprised to know that actually the UK 5-year fix is not driven by deposits and what banks pay. It's driven by the 5-year swap rate, the rate at which banks can swap fixed term deposits for floating deposits. And as we can see here, the 5-year swap rate has been coming down since July. And this leads new mortgage lending, and that's starting to fall. We saw data today that said new mortgage approvals were at a 3-month high. And actually first-time buyer mortgage rates have been falling since July. So yes, rates went high. That was bad for the economy, certainly bad for house builders, anyone connected with housing. But as we sit here today, the situation at the very least is getting less bad as it improves. Unemployment is obviously something that we pay a lot of attention to. It is indicative of the health of the economy. And UK unemployment has moved higher and is likely to move higher from here. Now, we need to watch this quite closely, but unfortunately, this needs to happen to reduce the upward pressure we're seeing on wages, and that is happening. So that will help ultimately inflation. We're also starting from a pretty low level in terms of unemployment. But additionally, if we were to think of people employed rather than the percentage of the labour force as shown here unemployed, then actually we have a record number of people in the UK in employment. So in terms of the impact on the overall economy, we still have a lot of people working out there spending. So the impact on consumption is perhaps not as negative as we might think from that unemployment rise. But that will rise further, and we need to watch that. So I've talked so far about the backdrop to the UK, which, as I said, is not the key driver of how we invest in individual companies, but this is a UK trust, and therefore we think it's important to talk about. That's the first point. The second point is, well, what are we paying to invest in the UK? And again, we look at each individual company and its merits. We want to find good quality companies that we don't pay too much money for. But if you think about the market in aggregate, which is important, because as I'm sure many of you will have read, there have been lots and lots of outflows from international investors from the UK and from domestic investors well over a number of years. So people do think about what is the valuation of the market as a whole. And certainly for us, we believe the price that one pays for any asset is very important, because if you pay too much, the chances that chances you can generate high returns for your clients are clearly more difficult. More importantly, if you get something wrong, there's a greater chance you can lose your client's money. And that's first and foremost what we think about. So when we think about that from a market point of view, we have two charts here, one about valuation, one about performance, and they're linked very much together. The chart on the left looks at a relative valuation of the UK in PEs, which is price to earnings, so the price divided by 1 year's earnings. It looks at the UK relative to the rest of the world. And the rest of the world really means the US here, in reality, because that's the biggest part of the rest of the world. And we can see here, and this data goes back to 1995. We've just come off the bottom recently, but in that, if my maths is correct, 28-year period, we've almost never been as cheap relative to the rest of the world as we are now. And the dotted lines are standard deviations. So statistically as well, we are more than 2 standard deviations cheap versus the average. The other interesting point I think here is that this is not something that existed forever. There were periods up until 2016, Brexit, where actually the UK traded higher valuation and moved higher relative to the rest of the world. Linking the chart on the left and one on the right, you can see the UK's relative performance to the rest of the world since 2016, again, Brexit, and bar last year, where actually the US market in particular was very weak and the UK stood up quite well, the UK has underperformed every single year. So when we put that with the chart on the left, it's very clear that the underperformance we've seen for the last 7 years has driven the UK to look very, very attractive, we believe, on a valuation basis. But many investors will say that the UK should be cheap. It doesn't have enough tech stock, so you should look at it on a sector neutral basis, which takes out those biases. Or the UK is full of old economy stocks. There's energy and banks. They don't grow very much, therefore they should be valued much more quickly. Much more lowly. These two charts try to address and answer those questions. So on the left, we're looking at a sector neutral basis. So taking out any distortions that may exist for having more or less in certain sectors. The data is not quite as long as the previous chart, but it still goes back 18 years in this case. And again, on a sector neutral basis, the UK is actually as cheap as it's ever been relative to MSCI world, the rest of the world in that time period. And the chart on the right, we looked at it slightly differently and said, okay, well, let's take out energy and banks. If that's the big issue here, let's look at how we are valued ex energy and banks. We've been lower relatively recently. But again, on that, in this case, we're going back to 2002, so 21 years, we're very much at the very bottom of the ranges we traded in relative to the rest of the world. And again, more than two standard deviations. In this case, one standard deviation cheap. So the three charts here on valuation show that any way you want to look at it, the UK is very attractively valued. One chart which isn't here, but is relevant, is thinking about the UK in terms of dividend yields. Very important for us in UK High Income Trust. And there the UK, as one might expect, with a very low valuation, is the highest yielding market anywhere in the developed world. So we're not paying very much relative to everyone else in terms of earnings, and we get a much higher level of income in the meantime. The summary of that, we believe, means that it's fairly clear to us that the UK is a very attractive place to invest from a valuation perspective. So why would you invest in the UK with a CT UK High Income Trust? We are UK focused, and the next point talks a bit more to that. And we have the highest yield in the sector, we believe, at 6.6%. So if income is an important part of your investment considerations, then we have the ability to pay a very high yield from an equity investment vehicle. I talked about UK focused. We have the ability to invest around 10% outside of the UK in order to take advantage of unique opportunities that cannot be accessed in the UK market itself. So there are certain areas of the market where the UK does not have very much or any exposure. Technology would be one obvious area where we can find businesses through our team of research analysts, with other investors, using that unique research platform and the scale that we have, can find businesses that give us opportunities we cannot find in the UK market. We can invest in those as well, which gives us the ability to drive higher returns, we believe, for shareholders. The aim of the trust is to produce a high and growing level of income with the potential for capital growth as well. And that's important. We're not deriving that high level of yield of income for our shareholders just by buying lots of companies that are really cheap, have very high dividends, but won't ever grow. We're aiming to buy businesses that provide a high level of income now, but where we believe that dividend income from those companies can grow into the future. So our shareholders know they can buy the trust, knowing that their income will grow into the future. Because we believe we're buying these businesses at very attractive valuations, we think that gives the potential for capital growth as well. Because it's an investment trust, we have the ability to use gearing to enhance returns. So where we think there are opportunities, we can use the ability to borrow to generate higher returns for shareholders. And the High Income Trust has a unique share class structure with ordinary shares and B shares. And this is part of what gives us the ability to continue to pay a very high level of income for our shareholders into the future. And the B shares, which receive the same level of dividend, that's paid out of capital rather than income, which can be attractive for some investors. So we think the UK is an attractive place to invest. It's not as bad as perhaps the media, many of the rest of the world make us think. It's in aggregate a very attractively valued market, and we think this is a great way to invest in the UK. In terms of a bit more about us, within the UK, we also have, and I alluded to this just now, a very strong UK equities team. We have a very large and very experienced team of UK investors. And that's the case whether this is income, obviously very important for us, what we would call core, so maybe non-income investors, which is also important because we want to grow those capital returns over time as well. So we do have companies that have lower dividend yields that can provide high growth, but also backed up by a small cap team, by central research analysts who spend all their time trying to find great companies for us to invest in, and by very strong responsible investment teams. So very well resourced, very experienced UK equity teams to help drive returns for all our clients. So I talked generally about the market. As I said many times during this presentation, we really spend our time trying to find great companies that we can buy at very attractive valuations to deliver very strong returns and income for our investors. I've got a few slides now just to talk about some of those companies, to try and bring to life the things I've talked about in perhaps a slightly abstract sense. The first stock I'll talk about here is Intermediate Capital. Not perhaps a company that many people have heard of, but this is a leading private markets business. What a private market means is private equity, private debt, infrastructure, property, and it's diversified across asset classes. Private market allocations, while they've grown considerably over a number of years, are still very low. And every pension fund, endowment, insurance, whatever it may be, they have a target to increase their private market allocations over time. So this will continue to grow. Fee levels have remained stable for a long time. In the public market asset management business, fees are under pressure. That hasn't been seen in private markets, partly because demand is just very strong. Fundraising and income have continued to grow very strongly, as we see in the top chart on the right here, consistently over the long run. But the share price has actually done very little in the last 5 years. Rise in interest rates actually have been a positive for Intermediate Capital, because the private debt they invest in, and this is how they started, so private debt's very important for them, is all floating rate. So as interest rates rise, the returns to their shareholders, to their clients rise. So you've got rise returns for clients, growing investment from clients, and yet the share price has done very little. The stock trades on around about 9 to 10 times March 25 price to earnings. It's gone up a bit recently, actually, after reporting very strong tech results. And has a dividend yield of around 6%. Again, that's come down a little bit as the share price has gone higher. And this is for a dividend which has grown at 21% in the last 5 years. So this is almost a microcosm of the type of business that we can find in the UK. Very attractively valued, lots of growth, but because it's attractively valued, we have a high level of income now. Another very different and actually much smaller business is Ibstock. Ibstock is the largest brick maker in the UK. They also make concrete products for construction as well, but bricks is the biggest part. The brick market in the UK is incredibly consolidated. There are 3 players effectively, with some small specialist providers, with the balance made up for exports. Bricks remain the material of choice in the UK market. They're embedded in planning. Imports, which are 20 to 30% of the market, are more expensive. Despite weaker volume, pricing has been disciplined, and the stock trades very cheaply. Dividend yield of 6%. Clearly, anything exposed to housing has had a difficult time. The house builders have cut back volumes, so it's a harder place to be. But this is a business that's used to existing through cycles, has a very strong balance sheet with limited debt. They're investing through the down cycles, so they come out stronger. Again, a great example of business which is, because of nearer term macroeconomic concerns, has been sold down very aggressively, but we believe has the ability to come out stronger and pays us a 6% dividend yield in the meantime. Now, perhaps that's a good moment for me to stop talking and hand back to Jake, and I'd love to take any questions that anyone may have.
Perfect, David. Thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. David, obviously we did receive a number of questions from investors, both pre-event and during your presentation this afternoon. Thank you to all of those on the call for taking the time to submit their questions. But Peter, if I may now hand over to you just to chair the Q&A session with David, and if I could ask you just to read out those questions and give your responses where appropriate to do so, and then I'll pick up from you at the end. Thank you.
Yes, of course. Hello, everybody. Welcome. My name's Peter. I'm going to be asking the questions to David. So, David, we've got a couple of questions regarding the valuations of UK companies. To start with, can you outline a couple of areas in the UK market where you see particular value?
I mean, I think there are several areas, as perhaps the conversation pointed out, but a couple of areas that jump out to me, particularly UK life insurance. It's an area, I think, which a lot of investors just thought that's far too complicated. We don't want to look at them. But this is a sector of the market where its biggest problem for the last decade has been low interest rates. They take on long-term liabilities, people's pensions and have to invest in assets to match them. When rates are going down and down, when their assets mature, it's very hard to get the same level of yield, and therefore that's a risk to shareholders. As interest rates have gone up, these stocks are even cheaper than they've ever been, despite having higher and higher levels of solvency, capital support them. So the likes of M&G, Legal & General, Phoenix, these are all businesses where solvency levels are around about 200%, but where their dividend yield is between 9 and 11%. So that's an area which is just classic. People don't want to invest in the UK. Perhaps we'll talk about that in a moment. They don't want to invest in anything it's too complicated, and that leaves very attractive valuations. Property sector is another one, linked slightly with the house builders, where been hit very hard by sentiment and by rising interest rates. The value of property is effectively the revenue streams discounted by a discount rate. As interest rates have gone up, the value has gone down. We know that. As is often the case, it pretty much appears that every stock has been treated the same. And many really good quality companies have gone from trading at premiums to NAV, net asset value, to discounts on net asset values that have come down a long way. So we own companies such as London Metric Property, primarily focused around logistics. Again, that's still a good area of the market, but we're getting attractive dividend yield. And a company called Supermarket Income REIT, which I've described as the Ron Seal of property companies. It does what it says on the tin, in that they own supermarkets on very long inflation-linked leases, so primarily to the likes of Tesco, Sainsbury's, and we can get a very high dividend yield as that stock's gone from, again, a premium to a discount. So there are two areas to think about, but I think there are many, many more.
Okay, interesting. And continuing on that theme, another question's come in saying it's well documented that the UK market is currently undervalued. Why do you think that is not getting a larger capital allocation? And what do you see as a catalyst to change the valuation gap other than continued M&A activity? And it goes on, it says, does the mispricing play into your hands from a yield perspective?
Yeah, well, I think it's probably one of the most important questions out there. There was lots of talk before the autumn statement about a BRISA, a sort of British ISA, in order to drive investment. I mean, part of it has been one of the biggest sellers of UK assets over a number of years has been the pension funds, as legislation or regulation changed such that it was harder for them to hold equities full stop. So they've been a continuous seller. And ultimately, for shares to go up, one needs more buyers and sellers. I think that's a big part of it. We are seeing, I think, one of the big US investment banks talk positive about the UK recently. We are seeing investors start to look again. I think it's no coincidence. We looked at those valuation charts of performance. They all changed dramatically post-Brexit. And I think it has taken all investors a long time to sort of understand that. If we do, clearly the UK politics has not helped. So I think there are a number of things, and part of it is just time. And as I said, it's pleasing to see that we're getting some better commentary. But so in terms of a catalyst, I don't really see one. It might be the fact that other markets just get too expensive, as we're seeing with the US now. As the question points out, M&A helps. I think we'll see more and more companies start to buy back their own shares. The Legal & General's gone from an 8% yield to 11% yield. Nothing's happened in the business. One gets to a stage for all businesses where, well, rather than actually doing higher and higher dividends, why don't we just buy back shares and drive shareholder returns that way? No, so I think that's not, I'm not picking legals particularly saying they will do it, but I think we can see that sort of thing happening. And it absolutely plays into our hands, because the low valuation means that we can get very attractive levels of income. And because we're buying what we think are good businesses cheaply, we believe we get capital growth in the future as well. So starting here today, it's a great time to invest in the UK, because whatever else happens, we'll get a high level of income here and now.
And on the income, is there a good vision with regards to future dividends and any forecasts in the future? Are we expecting any dividends to be cut in the next 12 months or so?
I mean, I think we're still seeing dividends recover from COVID. A lot of companies were either forced or took the opportunity to cut their dividends often to zero at COVID, and many of them have brought their dividends back at lower levels. So I would expect to see dividends grow into the future. And certainly for high income trusts, we would not invest in a company that's got a high yield if you thought there were any risk. So we very much expect all our companies to see dividends grow into the future. Now, some will pay special dividends at some points because of extra profits, and mining companies are a classic example of that. And that part of it becomes a bit more volatile. But in terms of ordinary dividends, absolutely expect to continue to grow into the future.
Sounds very comforting. Slight change of tack here then. The fund's approach to risk management. What is it, and how do you adjust your strategy in response to challenging market conditions?
I mean, to some extent, what we want to do with challenging market conditions is take advantage of them. It's challenging market conditions where often we see share prices sold off for no reason, and that's a great opportunity to buy great business at better prices. That's the first, I think, response. Approach to risk management, as you all might expect, we have a very strong risk monitoring team who regularly look at all sorts of risks, whether that's traditional tracking errors or factor risk or style risks. And then personally, myself, what I want to do is to ensure that we have as diversified a revenue stream and income stream as possible. So that's the first thing, is about concentration risk. And we want to have concentration risk when we're buying great companies. We need to think about the impact of portfolios overall. So it's a fairly standard approach to risk management, to be honest. At the portfolio level, the first thing is don't buy bad businesses, make sure your exposure is diversified, and then use the more technical risk teams that we have available to us to check all other exposures. I hope that answers the question.
I'm sure it does. If not, I'm sure they'll come back to us. You mentioned 10% is held outside the UK. Can you just touch briefly on where that exposure is? Is it up to 10% at the moment? Maybe give a stock example.
Yeah, absolutely. So one of the stocks we own is SAP. SAP is one of the world's largest software companies. They started out as a sort of ERP business, enterprise resource and planning, which basically means they run all of the back office for particularly large manufacturing businesses. So over the years, many large businesses have publicly changed to SAP, and Nestle, these types of businesses. And once the beauty of these things is that once you have SAP installed, you cannot take it out. It runs your business. It links everything together. It links accounting with supply chain, with sales. But what SAP do is they'll increase the functionality of the software over time. The business has moved from a license model to a software as a service subscription model. They moved from on-premise, where basically every time they upgrade, they have to go around with a floppy disk into people's offices and factories, to a cloud-based system. So much easier and frankly more cheaply to provide a level of service, but also provide a better level of service. And the SAP is probably one of the preeminent software businesses in the world. It's grown consistently 30 years for a business that started in Germany in the 70s and continues to grow now and has very strong results recently. The valuation isn't particularly expensive, but it's just the type of business at scale, at that sort of scale, we cannot access in the UK. So it's a great example of we can't access in the UK. We have the resource and the researchers to understand these businesses, and my European colleagues invest in it. Therefore, it's a great example of the type of business we want to invest in to add the ability to drive capital growth into the future. It's not a very high dividend payer.
Okay, and sticking on specific stocks, the questions come in. It's quite long, so bear with me. But the intermediary capital flow case seems strong, but this has been known and has had rate environments more supportive of it for many years. Results have been solid, but stock has derated. Having heard the bull case for this stock from many managers, I suspect this is largely in part a case of flows matching from active managers. So the question is, who are the marginal buyers here? Do you have a view on volumes? Would a simple easing of outflows from active managers be enough, in your view, to tilt the balance more favourably towards net buyers in that stock specifically?
Certainly the last point would help. End of outflows will help all of our stocks. That's part of it. I think intermediate capital gets somewhat moved around by general commentary on private equity. So there's been a lot of conversations in the last couple of years about the boom and bust we've seen in private equity in the US, whether it's tech or biotech funding collapsing as interest rates have gone up. Whilst that's true, that's really about VC, venture capital, really early stage investments where an awful lot of money was raised. That's not where intermediate capital plays. So I think that the share price gets impacted by larger market moves, it's a UK financial, so it gets caught up in the whole UK bank, UK insurance type conversation. I mean, I don't think it's very well understood outside of the UK. And actually, it's getting bigger, but it's not the biggest business. So I think there's a lot of scope for them to grow their shareholder base outside the UK. But even in the UK, I think there are still investors from whom private equity, perhaps could we say, is a bit of a dirty word. And I think there's more understanding needs to happen. From an asset raising point of view, they're still relatively small in North America. They have been there a few years now. There's still a lot of scope to grow organically in new markets. So I think that we actually had a call with the chief exec last week, and certainly they're very confident about the future and still see allocations growing. So even if the stock were not to move to a higher rating, we still think there's enough growth that see the share price do well and pay high dividends anyway.
Okay, and another question on similar on positions and holdings. Have the more growth-dependent positions previously held in Delivery Hero, ASOS, THG, etc., been retained or disposed of since you've been put in charge of the fund?
They've all been disposed of. But these are businesses that had done very well at times in the past. We think now it's clear that they were very much beneficiaries of, frankly, the world of free money that existed. And they're not alone. Again, a lot of money raised in venture capital in this space. And it's harder for them now. It's harder because the cost of capital is higher. Clearly, COVID brought forward a lot of that growth, so that they all carry on growing but at much lower rates. Delivery Hero, for example, is still seeing a lot of competition, even though its market's very strong, so it's the Middle East, which means I think the time for being cash positive, actually generating cash, it's been pushed further out. ASOS has had many, many well-documented problems. THG, again, they've got some good businesses, but I think it's not clear really what the future for the e-commerce business is. And then, actually, THG bought City AM a couple of months ago, which is completely outside of strategy. So we really want to buy businesses. We don't have to buy businesses that have dividends already. We want to see the prospect of growth and growth in income in a decent time horizon. I just can't see that with these businesses. So they've all been disposed of.
Okay, fair enough. And we'll finish on one question. We've just come up to 40 minutes now. So just finally from the viewers, what impact do you think the upcoming UK election will make on your investment decisions? I mean, we're obviously questions that we might be getting elections as early as May next year.
Really good question. The obvious answer is we don't really know what's going to happen. But the easy answer to that is it won't have much impact, because we are trying to buy businesses that we're going to own for a multi-year period that can prosper, and one can decide what prosper means in different environments, but can prosper no matter the economic or political backdrop. So that's the first thing. We shouldn't expect to see wholesale changes on the back of political change in the UK. That said, we clearly need to watch policy, because it may be there are certain areas of the market which are more advantaged or disadvantaged post-election. What we do know is that both Keir Starmer and Rachel Reeves, from a Labour point of view, are communicating and will spend a lot of time talking to business, talking to investors to understand what needs to be done, and to frankly deliver a high level of confidence to those sort of industry participants, and not to change things dramatically. It reminds me very much of pre-Labour coming to power under Tony Blair. Well, they knew their Achilles heel was mistrust in their ability to manage the economy. They spent a long time leading up to that election, 97, I guess, to make investors and business comfortable, and we're seeing the same thing again now. So clearly crucial as we go into next year, but I wouldn't expect it to make huge impact on our decisions.
Lovely. Well, that finishes the Q&A, so I'll pass you back to Jake. Thanks very much, David.
Perfect. David, Peter, thank you very much indeed for addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses where it's appropriate to do so. And of course, we'll then publish those on the platform. But David, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Thank you, Jake. Look, firstly, thanks very much, everyone, for taking the time to listen to me this afternoon. And what I'd like to leave you with is the message that the UK is still a good place to invest. The backdrop is nowhere near as bad as particularly the media, but others might like us to believe. And because of that, we can buy some great businesses at really good prices. And by investing through High Income Trust, you're able to get a high level of income now that can grow into the future. But the prospect for actually pretty decent capital growth as well, because we're buying good companies at such great valuations. So that's the message I'd like to leave with. Thanks again very much for your time.
Perfect. David, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT UK High Income Trust PLC, we would like to thank you for attending today's presentation. And that now concludes today's session. So good afternoon to you all.